So the defined return fund is designed to give investors, first of all, confidence in return of capital. Now, whilst the product is not guaranteed or protected, the capital is delivered by investment in US government bonds. So I would say a very secure investment underlying. And the idea is that investors who come in and hold to maturity will get back at least 101% of their initial investment. So that's the capital return element. The second part is exposure to Hong Kong equities via a derivative contract linked to the Hang Seng. And that derivative contract will have a barrier level. And at or around the 12th of March, we will set that barrier level. It will be 108% of the closing value of the Hang Seng at that time. If in 2 years' time, on the maturity of the defined return fund, the Hang Seng is equal to or above that barrier level, an additional bonus coupon will be paid. If it is below, no bonus coupon, you get the minimum of 101. That bonus coupon at today is looking to be around 14%. So over 2 years, investors have the potential to enjoy a 15% return on their investment. Now, the other critical feature on this, of course, there is no downside participation to the Hang Seng. If equity markets continue to decline, then investors are not exposed to it. So it's based on market research and the feedback that we've had talking to distributors and talking to retail investors. I think that there is a general desire to start easing back into China and Hong Kong equities given the relatively depressed levels, but people are afraid of volatility and afraid of downside. So Manulife is a solutions-orientated organisation, and we want to give strategies to clients that meet their investment needs. So we worked closely with our distribution partners to design the defined return fund. There's a number of factors. So I think the first one is we have to look at the absolute levels, which are clearly quite distressed. Look at the Hang Seng, for example, and notwithstanding the recent upward moves, is trading at levels that we haven't seen since around 1997. So on an absolute basis, very low. The second is the price earnings, the value. And if you look at a relative basis with Hong Kong equities trading around 8 to 9 times PE versus US market at 18 times, attractive from a valuation point of view. And the final one is, I think, the catalyst that we could well see in Asia, largely driven by China. We're already starting to see some meaningful shifts in government policy, and the PBOC has taken action recently, and this is proving a fillip to equity markets. Now, if that kind of catalyst continues, then I think that you have the opportunity to see a meaningful recovery in Chinese and Hong Kong equities. So it lends itself well to this kind of strategy.